Let me explain to you what each of these mean. I'm going to skip past the decision maker for the moment, and we're first going to talk about the market maker. The market maker is made up of large institutional traders. There are 3 market makers strategically positioned around the world, and there is one for each time zone. And for the most part, each market maker at each trading desk will work for around about 6 to 8 hours per day. Citadel, one of the world's largest trading desks, aka market maker, is an example of who we are attempting to play the game against. They have more than $62 billion in assets under management, and that was as of December 2022. And as I mentioned, their offices are strategically placed all over the world, one for each time zone. This image that you're looking at now shows you the trading desk that their traders sit at every day. And with this type of a setup, they are the people that are on the other side of your trade. Now, there's a bit of uncertainty around how involved in crypto Citadel is already, but they have been very open about wanting to set up their own exchanges or back other exchanges. By the way, backing means investing and also providing liquidity for, which essentially means market making. They will use a lot of clever words to make it not so obvious what they're doing. Aside from Citadel, some other crypto market makers are Jump Crypto, Virtue Financial, Cumberland, and until recently, Alameda, which you may have heard of because that was FTX's market maker. But I want you to look at this image very carefully, especially if you have been trying to trade for a while and it hasn't been working for you, but you don't want to give up and that's why you're now here. Stare at this image while I tell you a little story. Financial institutions like this employ traders to trade in different time zones across the world for about 6 to 8 hour shifts per day. Once the Asia market maker is done for the day, they hand over to the UK market maker, and then the Asia market maker goes home. Then the UK market maker does their 6 to 8 hour shift, and once they're done for the day, they hand over to the US market maker, and then the UK market maker goes home. By now, the market has been open for around about 12 hours. By the time the US market maker finishes their 6 to 8 hour shift, the market has been open for around about 21 hours. In that time, no market maker has done overtime or stared at charts for an excessive amount of time. And in fact, most sessions involve some sort of consolidation period where the market maker takes an extended lunch break. So in reality, it's quite cruisy for them. Now let's talk about you. You wake up in whatever time zone you're in. The first thing you do is grab your phone from the side of your bed and look at the charts, waiting for your eyes to adjust, just so you can check if you got stopped out overnight. Sometimes you do, sometimes you're safe. But in this story, you got stopped out. So now, whilst you're getting ready for work or trying to organize the kids or pay your business bills, you've got one eye on your tasks and one eye on the charts, desperately searching for a new trade to make back what you lost overnight. You're not focused, you haven't charted properly, your mind is in a low vibrational state because you stopped thinking abundantly, and now all you can think about is make back what you lost. The first session ends and there was no entry. 6 hours later, you convince yourself that the next session will give you an entry. You're now 6 hours into staring at charts for the day, and the first market maker is on their way to after work drinks. The new session starts, no entry. So you go start making dinner. Then your alert fires, and damn it, by the time you wash your hands and get to the computer, you see a massive candle. You waited all day for this. You're not missing out. So you enter, even though you know it's a bad risk to reward. You're chasing a candle. You have FOMO that it might not come back. So you'd rather be in than miss out altogether. Then after that one big candle that you got in at the top of, the price just goes sideways until the end of the session. Now you've spent 4 to 5 hours watching your trade go a little bit in profit, a little bit in loss, little bit in profit, little bit in loss. And now you're frustrated. But don't worry, it'll move in the next session. Now that market maker goes home, and the next one in the next time zone arrives for the day, 100% refreshed from a good night's sleep. But now you've been staring at charts with only one eye for 12 hours and still unable to take profit because you entered a bad trade. And now it's time for bed. So you tell yourself, I'll just wait up for the next session open. Next session opens, price doesn't move immediately. Oh, one more hour. Oh my God, I'm now way too overtired. I'm just going to go to bed. You wake up the next day, you're stopped out. The cycle repeats. Here's what you need to understand. Those market makers that only do 6 to 8 hour shifts then go home and get good rest. We're playing against them. There are many of them working in various locations all over the world, and they all work together. They work a 6 to 8 hour shift. They finish their shift. Then they pass it on to the next person in the following time zone. During the session changeover, one talks to the other about where the market should go next. And then with fresh eyes, the new one comes to the chart and they begin their 6 to 8 hour shift. Meanwhile, you are one person. You enter one trade and you sit there all day watching and nothing happens. It's just moving sideways. But they're getting on with their business. They're not even thinking about you. You get caught in a midweek reversal or a false move. They don't care about you. And now you're tired because you've been watching charts all day, so you make a bad trade decision. That is why we need time off the charts. We want to make high quality trades because that's who we're playing the ball against. So approach the charts bright and fresh, or don't approach them at all. These market makers know how you typically react to price action, and they do it on purpose. They know majority of retail traders will FOMO, and they play on your emotions to get you to commit to a trade. This will become more evident by the end of this lesson, so stay with me because we are going to outsmart them, don't worry. In addition to trying to take your money, the market maker is the liquidity provider to the exchanges. So they're the ones that will invest in assets, and then they provide those assets as liquidity to the exchanges for the purpose of allowing retail to buy and sell and trade them. So an exchange cannot list a coin without having a market maker offer it to them. A lot of people think the exchanges make the decision about what coins to list, but they don't. Those coins have to be acquired by a market maker early on for very cheap and sometimes free, and then the market maker offers it to the exchange, and that's when we, as retail traders, that's when we get to see the coin available to buy and sell. Meaning, by the time a coin gets listed on an exchange, the market maker is already well in profit, and it's only going to the exchange to offload it onto you, where you will either sell it, buy it, whatever you do, and whatever you do with that, the market maker is collecting profit. They may also make it available for leverage trading, in which case they will profit from the spread, which is essentially just the gap between the bid and the ask price. And the exchanges profit from the trading fees that you pay in order to open, hold, and close a trade. All parts of that incurs fees, and that's what makes the exchanges the financial player. They are essentially acting as the intermediary to allow the buyer and seller to transact for a fee. So when you think about leverage trading then, leverage trading is where you get to put up little margin and borrow the rest of your position for a trade. So the crypto you're borrowing has to come from somewhere, right? What you're borrowing essentially belongs to the market maker. The market maker has a deal with the exchange that they will allow retail to lend on the provision retail does not lose their money. So when you lose on a trade, you will only lose the margin that you put on the trade. You cannot lose more than this, because if you do, you're losing the market maker's money. The deal the exchange makes with the market maker is to put in a liquidation price on your trades. And essentially this is calculated by making sure if price hits the liquidation level, you will only lose your money on that trade and not the market makers. Now you know why liquidation levels exist. So if you think about it, the market maker is taking the opposite trade to you. They are trading against you, and they are also at the same time lending to you, meaning they lend to you to entice you to trade because they need you to open a position in order for them to be able to take it from you. And they know most people are greedy and will misuse leverage. So they lend to you, then trade against you to not only get their own capital back, but also profit off your loss from your own margin. Finally, there's the retail trader. And the retail trader is anyone who is not an institutional trader, basically not a market maker. So it's you, it's me, it's your friends, it's any successful trader that you know that trades from home, it's anyone that does not work for a large institution. We fall under the umbrella of the retail trader. And because there's a lot of people out there that learn to trade, some would assume that we outnumber the market maker. But this is not correct, because it's all about capital. The capital that we add to the market as retail traders means nothing compared to what the market maker contributes. So retail traders tend to believe that they are in control. You may have heard terms like the buyers are in control or the sellers are in control. That's retail believing that a lot of people are buying or selling at once, and that's what's causing price to move. The retail trader is never in control. And again, that is why we need to learn to understand how the market maker is initiating their moves so that we can be part of what they're doing as opposed to a victim of it. Now let me come back to the first one, the decision maker. This is the one that's going to sound a little bit unbelievable and a little bit scary, but what I want you to understand right now is that knowledge is power. And whilst it may sound like you have no chance from everything that I've said so far, that is absolutely not true. We cannot beat the market makers, but we can learn to play on the same side as them, and that is the point of the TBD system. So don't get discouraged. If anything, get excited, because by knowing what I'm showing you now, you get to be that much smarter, and that allows us to be on the right side of trades moving forward. The important thing to know is that whilst the market maker executes the trades, the market maker is not the decision maker. The market maker receives their orders from the decision maker, and the market maker's role is only to execute on those orders. The decision maker is the very people who basically control the whole world's money supply, the IMF, which stands for International Monetary Fund, and the World Bank. The IMF is regarded as the global lender of last resort. According to Wikipedia, the three primary functions of the IMF are to oversee the fixed exchange rate arrangements between countries, to provide short-term capital to aid the balance of payments and prevent the spread of international economic crises, to help mend the pieces of the international economy after the Great Depression and World War II, as well as to provide capital investments for economic growth and projects such as infrastructure. Now take that first point. Oversee the fixed exchange rate arrangements between countries. That basically means the IMF has the control over currency. They decide what something is worth, and they hand their decisions down to the market maker, and then the market maker gets to trade within their limitations, which we will get to. But they have weekly, monthly, and seasonal targets. So whatever they do, by the time the deadline hits, they must have the price of anything at the target that they were given. This isn't necessarily a bad thing. If the market maker were free to move the market how they pleased, they would have the power to collapse the economy. So in one way, it's a good thing that there is a market maker boss, if you will. But on the other hand, this is why the whole world is screwed, because there's only one entity that decides what happens to the whole world's economy, and they're not doing a very good job of it. In addition to the IMF, the World Bank is also a decision maker. The World Bank was established along with the IMF in 1944, and they work together hand in hand. So you might be thinking at this point, but this is crypto and crypto is decentralized. But here's the thing, the price of a cryptocurrency has nothing to do with whether or not that cryptocurrency is decentralized. Decentralization in cryptocurrency refers to the transfer of control and decision-making from a centralized entity, like an individual, organization, or group, to a distributed network. If you own some Bitcoin, you own it, and nobody can do anything to that amount of Bitcoin that you own. It does not have anything to do with the price of that Bitcoin. It can drop to $5,000, and if you owned one, you still own one. It can go up to $100,000, and if you owned one, you still own one. That is the part they can't control. But what they can control is the US dollar value of Bitcoin or any crypto, and they can only do that by owning enough of it that their decisions will move the market. And if you think that this only happens in crypto, don't get it twisted. This method comes from Forex originally, and is a method that I have applied to crypto, and when I did, I realized the same behavior happens at the exact same day, and often even the exact same time. So much so it's uncanny. So now you know who the players are in the financial markets, there's one more important thing to know.